And welcome back, it's JWalter here, and here's your latest housing market update. The number of people submitting loan applications for home purchases has dropped to the lowest levels since the spring months of 2020. This is according to the Mortgage Bankers Association, or the MBA. They actually just released this today at the time of this video, so I hope you guys get a lot of value of today's video. And of course, if you haven't subscribed already, then please do so. I post the latest housing market updates so you can make a more informed decision about whether you should buy or sell a house. And by the way, speaking of buying and selling a house, check out that link below, which is homeandmoney.com/Jason, to get connected with a great real estate agent in your neck of the woods. So with that said, let's go ahead and dive right into the video. This is according to the Mortgage Bankers Association, or the MBA. They posted this on the 25th of May. So mortgage applications decreased 1.2% from 1 week ago. And this is for the week ending May 20th. As you guys all know, if you follow the channel, total mortgage applications are broken up by refis and also purchase applications. Home buyers submitting loan applications in order to get a loan to buy a house. So no surprises here, the refi index decreased 4% from 1 week ago and also fell big time, 75% compared to the same week 1 year ago. Of course, because mortgage rates are about 2 percentage points higher now compared to 1 year ago. Of course, it makes sense that we're seeing a lack of people submitting loan applications for refis. So what we should be focused on is purchases though. So their unadjusted purchase index decreased 1% compared to the previous week and was 16% lower than the same week 1 year ago. And by the way, this is generally during the time of the year where our housing market should be in full swing. This is the end of May, which in general, our housing market really takes off in April through June of each year. So interesting to see how we're seeing a decrease in the purchase index compared to 1 week ago and also 1 year ago. So Joel Kahn, who's one of the MBA's vice presidents, had this to say: the 30-year fixed rate mortgage declined for the second straight week to 5.46%, but remains well above what borrowers were used to over the past 2 years. Most refinance borrowers continue to remain on the sidelines as a result, of course, and refinance applications have fallen in 9 out of the last 10 weeks. He brings up a very valid point because home buyers, in my opinion, are used to rates of around 3% because we've had that over the past couple of years. So here's the latest we have from Freddie Mac. They actually have a really good website here that shows average 30-year fixed rate mortgages since 1971. So as you can see here for 2021, for the entire year, the average rate was 2.96%. 1 year ago in 2020, it was 3.11%. And right now for 2022, through the month of April, we're at 4.09%. So basically a gain of 2 percentage points since 2020. So people have been used to rates around 3% over the past 2 years, in 2021 and 2020. Now rates are over 5%, and that's really impacting home buying activity. And by the way, just for fun, look at the average 30-year fixed rate mortgage in 1982. The average was 16.04%. In 1981, 16.63% for the average 30-year fixed rate mortgage. It was absolutely insane. Obviously, home prices were a lot cheaper back then, but this really is a rate we'd see for credit cards right now. Pretty crazy, 16.63%. Also, rates were above 10% for many years. So going back to 1990, so basically 1982 to 1990, the average 30-year was over 10%. And speaking of mortgage rates, here's the latest we have from the Mortgage News Daily. As you guys all know, we reached levels we have not seen since approximately 2008 at the beginning of May of this year, when the average was at 5.64% for a 30-year fixed. But as you guys can see here, mortgage rates have been more or less falling ever since then. So right now rates are approximately 5.27%. So in other words, mortgage rates have decreased by approximately 0.4 percentage points in the past 3 weeks. In any case, going back to this report from the MBA, Joel Kahn went on to say the following: higher mortgage rates are also impacting purchase market conditions as the purchase index remained close to lows last seen in the spring of 2020, when a significant portion of activity was put on hold due to the onset of this pandemic. Currently, higher rates, low inventory, and high prices are keeping prospective buyers out of the market. In regards to this purchase index decreasing to levels we have not seen since the spring of 2020, have a look at this. This is according to the Mortgage News Daily again. The dotted lines in this chart represent current levels for rates and applications as well. As you can see here, over the past, what is this? This is the past 10 years, mortgage rates have been increasing greatly. So approximately in August of 2021, we were at approximately 2.75%. And rates right now are approximately 5.3%. And here's purchase applications over the past 10 years. So as you can see here, rates of course increased greatly in the last half of 2021 and then also this year of course as well. And the purchase index basically was peaking in around January of this year, and it has fallen greatly ever since then. So right now, this dotted line right here is current levels. The index is at 225 right now. The lowest levels we had since about May of 2020. Before that, it was approximately the last half of 2018 where we had levels this low. And here's another graphic to show you guys regarding this change of the purchase index over time here. So this is over the last 5 years. Right now, as you can see, the purchase index has been basically decreasing this year as mortgage rates have been increasing greatly. And looking at this graphic here, the purchase index is at 225 right now, the lowest levels since May 4th of 2020 when the purchase index was 220. Obviously, it makes sense when mortgage rates have been increasing approximately 2 percentage points this year alone. Of course, it makes sense that we're going to see less people submitting loan applications to buy houses, of course. Another positive trend, though, that we're seeing in our marketplace is the share of people submitting loan applications for using adjustable rate mortgages. So the adjustable rate mortgage, or the ARM share of activity, actually decreased to 9.4% of total applications. Again, these are mortgage applications. Approximately 2 weeks ago, this rate was approximately 11%. So the rate has been decreasing, which is a positive sign. We don't want to see a lot of people submitting loan applications with ARMs, but the levels right now are about 3 times the levels since the beginning of this year, though. And changing gears slightly, let's talk about what the Fed had to say in their last meeting, which occurred approximately 3 weeks ago. This is because they just released their minutes from that meeting today at the time of this video. It says here the Fed minutes point to more rate hikes that go further than the market anticipates. And by the way, we're not talking about mortgage rates. We're talking about the federal funds rate, which is controlled by the Federal Reserve. This is the short-term rate that banks charge each other to lend money to each other. This is not tied directly to mortgage rates, though. It says here that the Fed is prepared to move ahead with multiple 50 base points interest rate increases this year. Federal Reserve officials earlier this month stressed the need to raise interest rates quickly and possibly more than markets anticipate. It goes on to say the following here. Not only did policymakers see the need to increase benchmark borrowing rates, that's the federal funds rate, by 50 points, but they also said similar rate hikes likely would be necessary at the next several meetings this year. It also says market pricing currently sees the Fed moving to a policy rate of around 2.5 to 2.75% by the end of the year. Again, this is for the federal funds rate. So what they basically mean here is that the market is already pricing in the federal funds rate to be at 2.5 to 2.75% by the end of this year. So in other words, the 10-year US Treasury note, which is tied loosely to mortgage rates, have already priced in the fact that the Fed is going to be increasing the federal funds rate through the end of the year. And this target range for the federal funds rate is consistent where they view this as a neutral rate. Statements in the minutes, though, indicate that the committee is prepared to go beyond there. And as the Fed moves to a policy to a neutral posture, the Fed is going to be increasing, of course, the federal funds rate and also reducing the size of the Federal Reserve balance sheet of mortgage-backed securities and treasury bonds. Also, it's interesting to see that the minutes mentioned inflation 60 times in their meeting minutes. Also, they said officials remain committed to raising rates and reducing the balance sheet. The minutes stated that doing so would leave the Fed well positioned later this year to reevaluate the policy effect having on inflation. Meanwhile, the yield on the 10-year US Treasury note, which is tied loosely to mortgage rates, is sitting at 2.75%. As you can see here, it has been decreasing ever since mid-May when we were at approximately 3%. So obviously this is one reason why mortgage rates have been decreasing, because the yield on the 10-year US Treasury note has been decreasing as well. So I hope you guys got a lot of value out of today's video. If you did, then please hit the like button. I greatly appreciate that. Consider subscribing if you haven't done so already. Hope you have an awesome day. I look forward to seeing you in the next video.